Most people were told the same story growing up. Work hard, save your money, and you'll be safe. But what if that story stopped being true a long time ago? What if saving money, the thing that's supposed to protect you, is actually what's holding you back? And what if the very system built to reward savers quietly punishes them instead? That's what this video is about. Because saving money, by itself, no longer works. And by the end, you'll see why and what actually does. For decades, saving was the ultimate symbol of financial responsibility. It meant discipline, security, preparation. Parents told their kids to open savings accounts, tuck away part of every paycheck, and build a cushion. The logic was simple. The more you save, the more secure your future. But look around. People are saving more than ever, and still falling behind. Across developed economies, trillions sit in savings accounts, pension funds, and cash investments that don't actually help the economy grow or help those savers build real wealth. So what went wrong? The problem isn't just bad luck or a few wrong moves. It's structural. It's how money itself now works, and why the world's old financial playbook stopped making sense. Let's start with something most people never think about. What actually happens to your money when you save it? When you put money in a savings account, it feels like you're setting it aside somewhere safe, like a box with your name on it. You think, the bank is keeping this for me. But that's not what really happens. The bank doesn't store your cash in a vault with your name on it. In reality, what you've done is make a loan to the bank. Your deposit is their liability. The bank owes you money, but they're free to use that liability however they want. Now here's the key misunderstanding. People assume that when banks take deposits, they lend that money out to others, that your savings fund someone else's mortgage or small business loan. That's not true. Banks don't lend your deposits. When they approve a loan, they create brand new money out of thin air by typing new numbers into the borrower's account. That's how modern banking works. Money is created by lending, not by transferring someone else's savings. That means when you save, you're not helping create new growth, new businesses, or new jobs. You're just giving the bank cheap capital, basically helping it look safer on paper. Your savings, in macroeconomic terms, are dead money. They sit still. They don't circulate. They don't build factories, or pay wages, or spur demand. The British economist Richard Murphy calls this dead money. He argues that the UK spends over 80 billion pounds every year, encouraging people to save through ISAs and pension tax breaks. But what do these savings actually do? Most of them are held as cash, or in shares that are second-hand. Meaning when someone buys a share, the company doesn't get that money. Another investor does. The company sees no new capital. So, at a national level, saving doesn't fund productive activity. It just props up financial markets and the banking system. The same pattern exists in many countries. Politicians still talk about encouraging saving as a sign of prudence, but the money simply gets locked away from the real economy. In other words, saving might help individuals feel safe, but it doesn't create new value for society. And in the long run, it doesn't even keep the saver safe. Because money that sits still loses power over time. That's where inflation comes in. Inflation is the silent tax that eats away at every dollar, euro, or pound you keep parked in a bank account. Imagine you had $100 in savings last year. 12 months ago, that could buy you about 35 dozen eggs. Today, that same $100 might only buy you 28 dozen. Nothing changed, except prices. The money didn't shrink, but its power did. And that's the trap of traditional saving. You feel like you're being responsible, but you're really standing still while the world around you gets more expensive. According to financial writer Kathleen Coxwell, saving is still important, but only for short-term goals, like emergencies or near-future purchases. For anything long-term, she says, saving alone is not enough. You have to invest. Why? Because investing turns your money into an active participant in the economy. When you invest, your money starts working for you instead of against you. It grows through ownership, not storage. Let's break that down. When you save, you're storing money. When you invest, you're using money to create more value. Investing is essentially an extra income source, not because it replaces your job, but because it lets your money earn while you sleep. Saving gives you safety, investing gives you growth. If you rely only on saving, inflation will gradually erode your wealth. But investing gives you a chance to outpace inflation. Historically, a basic savings account might earn around 3 to 5% a year, while the long-term average annual return of the S&P 500, one of the most tracked stock indexes, has been around 9 to 10%. That difference compounds massively over time. And compound is the key word here. Compound interest, or compound growth, is the single most powerful force in finance. It's what happens when your earnings start earning for you. The longer your money stays invested, the bigger the snowball becomes. Think of it like this: a small snowball rolling down a hill. At first it grows slowly. Then, as it picks up speed, every new layer adds to the next. That's what happens when your returns reinvest themselves. They generate more returns, which generate more returns. That's why people say the best time to invest was yesterday. The second best time is today. Because time is the magic ingredient. Now, a lot of people hear investing and immediately think of risk, of losing everything. But risk comes from not knowing what you're doing, not from the act of investing itself. There are simple ways to invest smartly, like using index funds or owning real assets that grow over time. And that brings us back to the core question: if saving no longer works, what does? The answer isn't to stop saving, it's to understand what saving actually is, and what it isn't. Saving is for short-term stability. Investing is for long-term survival. The financial advisor Andrew Hughes puts it simply: being a great saver might help you now, but over time it won't pay off if that's all you do. Because inflation is remarkably destructive, and the only proven way to beat it is to own assets that rise in value. Those assets can be shares in businesses, real estate, or commodities like gold and oil. These are the things that move with, and often ahead of, inflation. They're not immune to volatility, but over time, they protect and grow your wealth. Let's pause here, because this shift from saving to investing isn't just about personal wealth. It's about how the entire global economy works. Since the 1970s, when the gold standard ended, money has become a flexible promise instead of a fixed commodity. Governments, banks, and corporations operate on debt and credit, and the system relies on constant movement. Money that doesn't move doesn't help. That's why, as Richard Murphy points out, saving might make sense for an individual, but not for an economy. A country full of savers is a country short on spending, innovation, and growth. That's why modern governments spend billions incentivizing investment, not because they hate saving, but because economies depend on flow. Think of money like blood. It only keeps you alive when it's moving. But there's another reason why the old advice, "save your money," stopped working. The world changed faster than anyone expected. For most of the 20th century, savings earned decent returns. Interest rates were high. Banks competed for deposits. A saver could earn 6, 8, even 10% on their money, safely. But those days are gone. Today, the average interest rate on a savings account barely covers inflation. Meanwhile, the cost of living, from housing to healthcare, has exploded. So if you're saving just to keep up, you're actually falling behind. That's why millions of people, even disciplined savers, reach retirement and realize their money doesn't stretch as far as they planned. They did everything right. They worked, saved, lived within their means. But the system changed the rules mid-game. It's not just numbers on a spreadsheet, it's real lives. Think about Barbara Ann Patton, 88 years old, working as a notary in Florida. She once had $500,000 saved. She followed the traditional path. She retired early, invested carefully, and lived within her means. But a combination of inflation, bad timing in the market, and rising costs erased most of it. Now, she works over 20 hours a week just to pay her bills. She isn't reckless. She isn't irresponsible. She's the face of a generation that believed saving was enough and learned too late that it wasn't. Her story isn't unique. Around the world, retirees are returning to work not because they want to, but because their savings can't sustain them. Inflation, low interest rates, and unexpected shocks, like market crashes or housing costs, have eaten through their nest eggs. That's the reality of a system that rewards motion, not caution. So where does that leave us? If saving alone doesn't work, and traditional pensions aren't keeping up, then the only logical path is to make your money active. That means investing, not gambling, not day trading, but building ownership. When you invest, you're participating in growth. Whether that's a company, a property, or even a government project, your capital funds something productive, and in return, you share in the value it creates. Now, not every investment is equal. Stocks fluctuate. Real estate requires patience. Commodities can be volatile. But compared to money sitting idle in a savings account, all of these offer a chance to grow with the world instead of being left behind by it. The simplest way to start? Index funds. They let you own a slice of hundreds of companies at once, spreading risk automatically. Or, for those interested in tangible assets, real estate, rental properties, real estate investment trust REITs, or even small shares in global property funds, can provide both income and inflation protection. The point isn't to chase returns, but to avoid erosion. Because the biggest risk isn't losing money, it's doing nothing while the world changes around you. And that brings us back to the bigger picture. Richard Murphy's dead money theory isn't anti-saving, it's pro-investment. He argues that governments and societies should direct resources toward productive activity, building infrastructure, funding renewable energy, developing new technologies. When money sits in banks or pension funds, it serves balance sheets, not people. But when money funds new value, that's when economies grow, jobs multiply, and societies thrive. So imagine a world where the incentives flipped, where governments rewarded productive investment instead of passive saving. That could mean tax breaks for companies that build affordable housing, credits for startups creating green jobs, or support for funds that finance real economic projects. That's not utopian, it's just a smarter use of capital. And at a personal level, it's the same principle. Saving is just the first step, investing is the second, and the one that actually matters. Because in the end, the economy doesn't reward caution, it rewards contribution. Money was never meant to sleep. So, the next time someone tells you just save more, remember this. Saving is about protection, not progress. It's the foundation, not the finish line. To build wealth, real lasting wealth, your money has to move, grow, and work. The world doesn't pay you for what you hold, it pays you for what you build. Watch the next video and see how the people who understand where the money's moving next always win. And if you're serious about staying ahead of that shift, hit subscribe. You'll want to see what's coming next.